The bank also pointed out today that the fall in the pound was going to help exporters by making their goods cheaper abroad. Globally, one guide to world shipping demand, the Baltic Dry Index, has even nudged up a bit over the past 2 months. But nearly everyone thinks the bank will need to do more. Rates can go down to zero. In effect, the American central bank is already there, and Japan is close. But in these extraordinary times, even zero interest rates might not be enough. The problem will be familiar to anyone who's ever wasted their money on one of these. The Bank of England's piling money into the banking system, but then it's getting stuck. The machine's getting clogged up because, thanks to the credit crunch, there are fewer banks wanting to take advantage of those low interest rates and loan the money out to the rest of the economy. And it's not just banks. With all of this bad economic news, nearly everyone's worrying about the future and holding on to their cash. That's why a lot of people say the bank needs a way to give the system a kick.
The key problem about credit in the United Kingdom, it's not its cost anymore. It's cheap, relatively cheap, its availability. And this means that the bank must forget about interest rates now, and it's got to talk about so-called quantitative easing, which is essentially stimulating the money supply directly.
There are a few ways to do that, but the simplest is for the bank to go out buying up debt with money it's created out of thin air.
It is a form of printing money, but I would also say it's really not that different from private banks lending, as we saw during the boom. They were effectively printing money. A central bank is merely replacing the role of private banks because private banks are unable to lend.
In Times Square this week, a US website decided to go one step further. Its bailout booth was literally giving cash away. I don't think the Bank of England will be opening a booth anytime soon, but you never know. We'd have thought 1% interest rates were crazy a year ago. Stephanie Flanders, BBC News.
Well, while the latest reduction spells good news for many borrowers, it's also been described as an assault on savers. Personal finance experts point out that savers have seen interest payments fall by more than 80% in relative terms in the past 18 months. Our chief economics correspondent, Hugh Pym, looks at their predicament.
Cuts in interest rates mean more money for borrowers. There's more coming through to their wallets once they've paid their monthly mortgage bills.
Alex, do you want some?
The biggest winners are those like Tim Ross with interest-only tracker mortgages. He's already seen a big cut in his monthly payments.
A year ago, I was paying £995 per month, and my last month's payment was £275. So it's a massive difference.
But in contrast, the money for savers is shrinking, with lower levels of interest coming into their piggy banks. Even before today, some rates were below 1%. That hurts people like the Harrises. They're both retired and rely on their income from savings. That's fallen, and they're feeling the pinch.
You're not only not getting the interest, you're eating into your savings all the time. So your savings going down, your interest is going down. So never-ending circle.
We shouldn't be in this position now at our age after all this saving and preparing for our old age, that we've got in this sort of situation, and it's not us that's spending the money.
Mortgage lenders have previously welcomed rate cuts to help the housing market, but not today. They were forcibly arguing the case for savers.
Savers are being punished, essentially. They've had their income absolutely decimated and will feel robbed that they've gone through their lives, particularly pensioners, with prudence, with thrift, and now they're getting no return on the money at all.
The Bank of England, of course, wants people to borrow and spend more rather than save to pull the economy out of recession. That's why it's cut interest rates so much in the last few months. But that's a bitter pill to swallow for savers, whose complaints have been more audible than the opinions of borrowers about the benefits of rate cuts. Hugh Pym, BBC News, at the Bank of England.
Coming up on tonight's programme.
I just feel within